Hello, everybody, and welcome back. Today, my guest is Joohee An. She's a senior portfolio manager from Mirae Asset Global Investments, and today we want to discuss about recent events in Asia and influence on Asian financial markets. Welcome, Joohee An.
Hello, good morning.
Joohee, the war between Ukraine and Russia is driving commodity prices, consumer prices, and inflation on a global base. How will this affect Asian consumer behavior and consumption?
Compared to other regions, the negative impact of the pandemic on consumption has been more significant in Asia already due to its stricter restrictions for the last 2 years. Except for China, which will maintain its zero COVID policy. The most Asian countries are just starting to gradually ease the social distancing rules and switch their policy closer to living with COVID. So consumer sentiment and mobility are improving, and we expect to see a sequential recovery of consumption for the next quarters, driven by pent-up demand. However, the current geopolitical issue and possibly another wave of commodity price inflation could make this overall consumption recovery pace much slower. So besides increasing fuel costs, most companies will try to pass some part of incremental costs onto consumers by raising prices. As we have seen since the pandemic began, the lower income consumers had a bigger impact on income growth and job security. So price increase across sectors, including fuel and daily products, will hurt the recovery in purchasing power of this group more again. So also it will negatively affect the current recovery of mobility. Thus, the consumer's online engagement level could stay deep even post-pandemic. So another impact that I think of is that the higher fuel costs will accelerate consumers' adoption of electric vehicles. So the Asian countries actually they are mostly energy importers. So the correlation between the crude oil and retail gasoline prices is higher when it is on the uptrend. So especially in China, the consumers' demand for electric vehicles has risen significantly since late 2020 and continued to post its strong growth of 161% year on year last year. So this strong demand for new energy vehicles will remain one of the most exciting trends in the consumer market if fuel costs keeps rising.
Should we expect a new wave of supply chain disruptions? So we have seen this during the COVID-19 pandemic as well. And which industries and companies in Asia are likely to deal with this better?
Obviously, the Russian-Ukraine conflict exacerbates existing supply chain disruptions and inflationary pressures. But silver lining is that most companies or countries have actually made lots of efforts to address the problems coming from the supply chain disruptions for over a year now through the pandemic. The companies have tried to figure out the exact bottlenecks in their supply chain and have strengthened their supply chain management by securing more various sources and investing in technologies or building their in-house capacity and also skills to integrate some part of the chains. So regarding these efforts, I think the Chinese companies seem to be better positioned to mitigate the negative impacts of the further disruptions driven by the current geopolitical issue. So we have already witnessed that normalization pace of chip shortage issues is much faster in Chinese automakers than in other countries. So they have easier access to diversify supply sources using local partners, and their well-developed manufacturing skill and infrastructure can support their efforts to internalize some parts of the chain. So this supply chain disruption keeps elevating the inflationary pressures as well. So we will see more kind of divergence in business results between the companies depending on the raw material cost to sales ratio and the pricing power that can allow them to pass the incremental cost to customers by product mix upgrade. So, for example, the high-end cosmetic companies in consumer sector have a lower ratio of raw materials to sales, and the customers can more easily accept the higher price products.
Chinese A shares underperformed in 2021 after having 2 strong years. So what were the reasons for this, and what is the case for China A shares in 2022?
So in 2021, the overall Chinese market, not only A shares, so I think even H share underperformed even more. So in 2021, that year was the first year of the 14th five-year plan. Also was a transitioning year in a big change of policy direction in China to move its focus more to quality growth of the economy. So also it was a year before the time when President Xi would probably be confirmed to remain the party chief. So against this backdrop, the government initiated many new regulations to address the side effects of the fast-growing industries and also build a new base to pursue quality-oriented growth. So with the new regulations, the companies are making significant changes in their business structure, leading to share price corrections in various sectors. So the government tightening on the property sector also reflected the government's new direction of the policy, which led investors to concerns over macro risks. Another background for the market underperformance was its zero COVID policy. It had worked pretty well, relatively well, until first half of last year, but it started to cost much more since the Delta and Omicron variants outbreak. Due to its more transmissible character, the governments needed to restrict mobility in more areas. However, we expect better performance for China this year, 2022. First, as the government suggested, its top priority for this year has changed to stabilizing the economy. They announced the rate cuts early this year, which is the opposite move from other countries. And also, we expect more fiscal policy support throughout the year. And secondly, after the recent underperformance, we are starting to see good values in lots of Chinese stocks, of which earnings growth outlook remains robust. And the third point, as I mentioned earlier, actually Chinese companies are expected to have less negative impact from the current supply disruption, thanks to their higher level of flexibility of sourcing internally within the country. So regarding these countries' zero COVID policy, it is unlikely to see them switch to living with COVID quickly for the time being. However, we also hear that the government is gradually mulling over the timing to ease the restrictions. So lastly, considering further market volatility driven by the current geopolitical issue, actually China A share will likely see more inflows. We have seen lots of inflows because its correlation with the global market is relatively low. So we are more positive on China for this year compared to last year.
So you already touched the topic slightly. Chinese internet stocks in particular have been underperforming due to the regulatory measures under the Common Prosperity Initiative. So how attractive is the sector nowadays?
When we talk about the attractiveness of stocks, there are two sides. So one is earnings upgrade potential, and another one is valuation re-rating potential. So after significant correction due to the regulatory issues last year, China internet stocks currently trade at the low or lower level of the historical range. So as online services have become more important in daily life through the pandemic, and these internet companies will keep evolving into new areas such as metaverse and etc. But we think this sector will keep growing and leading new patterns of consumption behaviors. However, especially in China, we do not expect too much for valuation re-rating going forward. I mean, this whole China online sector compared to the last 2 decades. So considering the new regulatory environment, they have less potential to release positive earnings surprises from the unexpected kind of synergy between core businesses and the new businesses, just like they did for the last 2 decades. So therefore, the fair valuation cannot be derived from kind of comparing the historical level. Having said that, we expect to see the recovery of the consumption activities at some point in the second half this year, thanks to the government's efforts to revitalize the economy and the possible relaxation of a zero COVID policy. So we think the earnings recovery of individual companies in this sector will be the main driver for the share price recovery, because already the expectations is very low and it's all kind of priced in. So I think the main driver for the companies in this sector is not going to be like substantial re-rating of the whole sector. It's going to be kind of the real earnings, kind of positive surprises. So the kind of individual companies' result is going to be a main driver going forward.
So you're closely observing Asian consumption trends, and we were wondering, what are the main differences in consumer trends in China, India, and the ASEAN countries, and what long-term consumer investment themes do these regions have in common?
Yeah, because of the differences in culture, economic, and industry development, etc., the consumer markets in each country or region have shown different trends. However, that gap has been narrowing, it seems, as we are going through the pandemic. So in China, consumers are more tech savvy and become early adopters for new products or services. So for example, the electric vehicles industries is growing at a significantly higher rate than in other countries since late 2020, driven by real consumer demand, not government subsidies or corporate demand. Also, Chinese consumers' preference for local brands keeps rising, as well as the younger generation's patriotism. Actually, their deeper engagement in online services also drives this trend, because they can easily access detailed information about products online. So compared to the older generation, brand name itself actually plays a much less role when they decide what to buy. So they compare kind of most aspects of the quality of the products and the prices rather than just brand name. So this habit supports many local brand companies who make good quality of products, but have had less brand power to compete with well-established brands. So China's manufacturing industry has grown strongly for the last multi-decades as OEM. So there are many local companies with good skills and capabilities. So combined with new formats of online shopping, it offers consumers more opportunities to find good quality local brands. These Chinese characteristics in consumer market used to be very unique compared to other Asian countries before. However, since the pandemic began, we see that the similar trends are coming up in India and ASEAN consumer markets as well. So the pandemic triggered these consumers to have deeper engagement in online services, including e-commerce and online games or e-payment, etc. Also, the development of online channels also lowered entry barriers for smaller size local companies to compete on online platforms. So in the past, due to its smaller scale, actually those kind of the small local companies, they couldn't even have chances to be distributed to main offline store channels, as infrastructure development is still behind in these countries. So although consumers' preference for local brands is not yet as strong as Chinese consumer, but this is a big change that can build more opportunities for local brands to grow further. So besides these trends, we see most consumers across Asian countries are willing to spend more on health or wellness related products or services, which was also triggered by the pandemic, it seems. So it connects to their new spending habits that prefer premium products despite less volume they can afford, even in non-food segments. So this premiumization trend is another promising theme that can be applied to these countries in common.
So this was Joohee An, Senior Portfolio Manager at Mirae Asset Global Investments. Thank you very much, Joohee, for sharing your insights into Asian consumption trends and investment opportunities in this area.
Thank you very much for having me today.